Thanks for joining us on a Friday. Um, I don't imagine we would have ever predicted we'd have a Friday like this a few months ago, but I'm sure we're all getting pretty good at working from home or doing whatever our daily routine is like now. Um, my name is Jason Sharp. I'm a tax partner with Briggs & Veselka, and um, glad to have you guys with us here today. Just as a little bit of background, we had done some webinars a couple weeks ago around the CARES Act, PPP, that sort of thing. And today we just wanted to provide some updates and also spend a lot of time on the forgiveness piece. I think that's what's near and dear to everyone's heart now. We've all learned how to get the PPP loans, but now what's going to happen with the forgiveness piece. So we're sort of divided into a couple of parts. First part's going to be on the forgiveness piece, and then there's been some updates to some of the tax information. And with that came some self-employed questions as well around the PPP program. So we're going to touch on those. But let me turn it over, or actually, we just go to the next slide. I'll refresh everyone's memory. Washington, sort of with the pandemic, has had what they call 3 different phases. The first phase was to postpone some of the tax deadlines that were originally set for April 15th. Those have been pushed back to July 15th. We'll touch on that on the tax slides. There's been some updates for that. Then we had phase 2, which is the FFCRA. We've got a little bit of information on that, but we'll touch on that in a little bit. And then phase 3 was the CARES Act, which provided the SBA and PPP loan program. So as we did in our other webinar, we're going to go a little bit out of order here. We're going to talk about phase 3 because that was the most powerful of the responses and the one that we're getting the most questions on and seems to be catching the most attention. And we'll touch on the other 2 in terms of some updates shortly. But we're going to jump right into the PPP and the loan forgiveness. So I will turn it over to my colleague Eric.
Great, thanks, Jason. And just a couple housekeeping items to add as well. There should be a Q&A portion on your screen. I think hopefully a lot of us are kind of accustomed to these webinars, but certainly feel free to ask any questions. We have one of our partners, Rick Westerfield, on the back end typing out frantically responses to everyone. So certainly feel free to pose those questions and we'll get to them. And if we don't address them live, we'll certainly follow up with everyone afterwards. So what we know today can change tomorrow. I think kind of going through this process, I think the CARES Act rolled out on March 27th, and to me it feels like March 28th. This has just gone by so fast, but there's continuing to be guidance coming out on a daily basis, sometimes even hourly basis. So, basically our comments today are what we know as of today, and just keeping in mind that those will change, which really is what prompted this webinar, kind of doing an update and possibly doing more as things keep going. So as a brief review for the SBA, like Jason said, our focus today will be on the Paycheck Protection Program. Just to kind of review all of those, for all of those who are trying to keep all these programs straight, the Paycheck Protection Program is meant to keep employees on the payroll. And for companies that use the loan as directed, up to 100% of those funds can be forgivable. The second program is the Economic Injury Disaster Loans, or more affectionately known as EIDL. These loans do require repayment, albeit at a lower interest rate and a longer term than most traditional SBA loans. One of the more significant components of EIDLs is that businesses can apply for an emergency grant that pays up to $1,000 per employee, capped at $10,000. And this $10,000, if received, never has to be repaid back. It's a true grant, even if a subsequent loan application is no longer approved. So with that being said, the advances seem to be somewhat MIA. They were originally promised within about 3 to 5 business days of applying for them, but we know several who have applied as many as 2 weeks ago and still have not received anything. The SBA, I think, is just completely overwhelmed with the volume of applications that they received. But for those that have applied, it is hopefully coming. Wish I had a better guidance on when, but we're hoping those will start coming through soon. The last two programs are available for businesses who already have a relationship with an SBA lender. The bridge loans are meant to provide capital for businesses that have either a loan application pending with EIDL or already have an SBA loan. In most cases, the bridge loans can be refinanced once a more permanent facility is put in place. Finally, the small business debt relief program might be the most straightforward. This is where the SBA has said they would pay principal, interest, and fees for the next 6 months for any current SBA loan that's in existence or that's active. So it's essentially a 6-month waiver for SBA loan obligations, and that's all facilities 7A, 504, or microloans. So how did we get here? Again, this is kind of a headlines of what's gone on here in the past couple weeks. What's not reflected here is the daily guidance that comes out. There's an FAQ posted by the Treasury and SBA almost on a daily basis, and so those are scattered through here. But where we are today, or maybe even yesterday, is that we learned that the original $350 billion that was appropriated for the CARES Act has officially been depleted as of yesterday morning, and the SBA is unacceptable per their website, is unable to accept PPP or EIDL loan applications at this time. So it's unfortunately kind of come to what we hope is a temporary pause. But for a little bit of perspective, the SBA approved and funded about $28 billion in SBA loans during the entire calendar year of 2019. Now, in less than 2 weeks, the SBA has funded, at last check, over 1 million applications from over 4,000 lenders, funding that nearly $350 billion in loans. And I say nearly because some of those funds were allocated to other recipients that may or may not make sense to some folks. But nevertheless, the volume in that short a period is nothing short of astronomical. And so again, the SBA is just completely inundated with these. So especially to those of you who have ever obtained an SBA funding in the past, so it is usually a long and very drawn out process. So the fact that they're able to do it so quickly is pretty impressive. That said, we do believe there's additional SBA funding on the way, as much as another $250 billion. What we do not know is when these funds are expected to be appropriated. The last I saw, the increase was being discussed in the House in typical Washington fashion. So hopefully there's more relief on the way. For those of you who are considering applying for the PPP or are going through the application process, we feel it's best to keep pushing forward as quickly as possible and get in the queue for this next round, assuming it comes through. It's also important to maintain constant communication with your lender, since they're the ones ultimately processing these. We've heard that some banks are continuing to accept applications, even though they cannot be currently processed by the SBA. And again, that's all in anticipation that that next round of funding will come through. So we're optimistic that it will happen, but again, just not sure on the timing of all this. So in turning to forgiveness, the first step in analyzing PPP loan forgiveness is understanding how the loan amount was originally calculated. So as a refresher, this is from our last webinar. The maximum loan amount is the average monthly payroll cost multiplied by 2.5 less any advance taken under the EIDL. Calculating the average monthly payroll cost is the main driver here. We won't go into too deep a detail on this, but we will walk through an example to kind of illustrate how our interpretation of how this works. But the main takeaway here is to remember that the information that goes into actually determining your loan amount also carries over to the forgiveness side. So going through the application process is, while it's very fast, it's important to be deliberate and meticulous in how you're calculating the amount. The best way to maximize payroll costs is to be sure you include all allowable costs, which again, we don't get too deep into this specific webinar, but it's something we can assist businesses on an individual basis to ensure companies are qualifying for the maximum proceeds. Businesses applying for the PPP can do so in a relatively quick fashion. which is seemingly by design. I think that's in an effort to get companies cash quickly during this economic crisis. So the flip side of this is that the applicant is applying for and obtaining loan forgiveness. So the true-up period is coming, and loan forgiveness is not guaranteed. It has to be earned in the sense that companies are going to have to prove out expenses or that they use the funds appropriately. So this slide makes it look easy, and I wish the presentation ended here. But as we walk through the example, we'll see some of the ambiguities that exist and where further guidance is needed from the SBA, which we hope will come soon. But we'll walk through what we know as of today. So in thinking about forgiveness, I might call it a reverse underwriting, in that companies are receiving and using loan proceeds really before the bulk of the underlying information is analyzed and quote unquote approved by the lenders and the SBA. So it's really the documentation and the actual analysis is coming on the back end. So living up to its namesake, the Paycheck Protection Program requires at least 75% of the loan proceeds to be used for payroll costs. The remaining 25% can be used for rent, utilities, interest on mortgages, and interest on other debt obligations, I believe, that were originated prior to February 15th. This 75-25 allocation is one of the main requirements that we think will be analyzed in looking at loan forgiveness. And interestingly enough, this was actually not included in the original CARES Act. It came out in one of the subsequent guidances from the SBA. But the idea here is to guide companies to use the proceeds for payroll costs specifically. So to help illustrate this, we'll walk through a very abbreviated example. And again, keeping in mind that the real life version of this will be much more granular. The numbers used here are fairly random and may not even be 100% proportionate. But the idea here is to illustrate the mechanics of how we believe this is going to work. So as I mentioned before, the first step in obtaining forgiveness is looking back at how the loan was originally calculated. So we actually start on the right-hand side of the screen here and add up employees' gross wages, keeping in mind that we can only include up to a maximum of 100,000 annualized gross wages. So you'll see employees 7 through 9 here are capped at 100,000. But you can include that first 100,000. You don't have to exclude them entirely. So next, moving to the left-hand side of the screen, we'll add employer health care and retirement contributions, along with state and local tax assessed on the compensation of employees. Then on the exclusions, starting with line 6, we'll adjust out the delta of employee salaries that exceeded 100,000 per year. We adjust out salaries for employees whose principal place of residence is outside the U.S. Oops, sorry. And then we'll also exclude any credits taken under the FFCRA. And again, these are numbers are for illustration, so that may or may not apply to all businesses here. Let's see, so we've adjusted that out. Let's see, for borrowers who have received, so I guess that gives you the net payroll cost, and then from there, dividing it by 12, and then applying the 2.5 times multiplier to get that 225,000 is the kind of loan amount where it stands now. For companies that participated in the EIDL program, you do have to subtract out any advance that you may have received. And again, it seems like those are MIA, so I'm not exactly sure how many companies have actually received these. But for those who have, you would subtract out any grant that was received. And companies do have the option of refinancing EIDL proceeds into a PPP. So a scenario like this could exist where a company obtained an EIDL loan and used that EIDL loan for qualified costs like payroll. And if that were the case, they can refinance that up into the PPP to get those forgiven. But again, it depends on how that EIDL was used. So we've left that out just to keep things simple in this example. But we can, kind of follow up with companies on an individual basis to illustrate how that would work. So now on to forgiveness. We ran a couple scenarios to demonstrate some of the potential outcomes, but again, the real life version of this will be much more detailed. Remember that to qualify for 100% loan forgiveness, 75% of the proceeds must be used to cover payroll costs, and no more than 25% of the proceeds can be used for rent, utilities, and interest. So in scenario one, we have a company that used PPP proceeds for qualified expenses, but did not quite meet the minimum threshold of using 75% of the proceeds for payroll costs. This would result in a small balance owed after the forgiveness of about $6,000 or so. The company would receive all forgiveness for the payroll costs, so that $158,000. The difference would come out of the non-payroll expenses that were used there. So in scenario two, this company meets the 75% payroll rule, which qualifies it, which qualifies the entire amount for forgiveness. And again, we're looking at the 75-25 rule in isolation here, so keep that in mind. But something to keep in mind, not achieving 100% forgiveness is not necessarily bad. The company in scenario one has received 90% or 97% loan forgiveness. Again, in this simple example, which is still highly positive, but it just goes to show how deliberate business owners need to be when using their proceeds and tracking these expenses, because obviously with larger loan numbers, this could have bigger impacts. So next, we'll talk about two forgiveness adjustments that are officially a part of the PPP, but where little guidance has been issued on how this is actually supposed to work. So we've left a placeholder here as these two adjustments that we'll talk about would affect the ultimate forgiveness amount. We actually tried, our team internally were trying to model this in yesterday, but ultimately we couldn't get comfortable in actually putting numbers into it and having that and feeling comfortable with that being accurate based on what we know at this juncture. So the first adjustment covers any reduction in the number of employees. Remember that payroll costs, that first gray box there, are the costs we calculated a couple of slides ago, which is calculated, could be calculated either on a trailing 12-month basis or calendar year 2019. If average FTEs decrease during the first 8 weeks the loan is originated, then the loan forgiveness amount would be reduced, mainly since the purpose of this loan is to keep FTEs employed during the crisis. If there is a reduction in FTEs, businesses have the option how to calculate the forgiveness of the reduction, and that's a lot of where the clarification is needed, especially on what the formal definition is of an FTE. The SBA has a stated definition, but they have not commented on if that definition applies for purposes of this calculation. We also need some additional clarification on the timelines, some of which kind of conflict of each other and some don't make inherent sense. So again, this is kind of what we're looking for the SBA for guidance on. But the takeaway here is to be extremely meticulous in tracking employee, not only their payrolls, but also coming and going, hiring dates, and that sort of thing as well. So second adjustment is more of a direct adjustment based on the wages paid to employees. This is where forgiveness amount is reduced by the amount of pay cuts exceeding 25% for employees earning less than $100,000 per year. So again, it's important to track data here, and we do need additional clarification. The rule states that you would compare an individual employee's compensation to the most recent full quarter. However, the purpose of the PPP is for payroll over the next 8 weeks. So there's kind of a disconnect there in how you would actually calculate that 25%. And again, this is what we're looking for additional guidance on as well. So in light of all the questions still outstanding and the guidance needed on loan forgiveness, the best thing borrowers can do today is document everything, even down to the day on payroll costs and employee activities and that sort of thing. That way, when it comes time for forgiveness and the application to be processed, which I should have mentioned earlier, can be done 8 weeks after the loan is funding. So the timeline on this, the clock starts 8 week, or the 8 week timeline starts at loan origination. So for a company that's received PPP funding, They have 8 weeks to spend those proceeds. And then after that 8 weeks is when the forgiveness is ultimately applied for. And this program lasts up until June 30th. So, but it's based on when that loan is actually originated. So with the frequency of new guidance that's released, we're not entirely sure of what the specifics of the forgiveness process will entail, but we encourage businesses to over-prepare in terms of keeping track of information and also keeping in touch with their lenders as well, because this would be going through records. Or going through the bankers. So in keeping clean records, opening a separate bank account would help to kind of segregate all these costs and really kind of work towards keeping clean records. This isn't necessarily a requirement, but it might help companies really track the exact use of proceeds and make the forgiveness process a little bit more straightforward. Keeping evidence of rent, interest, and utilities. Again, this goes to proving how the expenses or how the proceeds from the loan were used to cover expenses. And also for those that use a PEO, kind of keeping in touch with them and making sure you understand how to pull reports and how to really dig down deep into the details of payroll costs, and consulting with tax advisors and others that can help maximize the forgiveness amount. But the key here is being deliberate in collecting data and holding on to it. So our closing thoughts, I talked a little bit about the timeline. Lenders have 60 days to make a decision on forgiveness. And so in the absence of guidance, lenders will be left to interpret forgiveness calculations on their own, which is again why we're hoping to receive more official guidance from the SBA. And that guidance we're hoping for pertains to the application process, the forgiveness adjustment, and tax implications. So remember that for not achieving forgiveness is not necessarily all bad. It's repaid. Any balance that's left over is repaid over 2 years at a very low interest rate of 1%. And so, while there may be a balance there, most likely it is still helpful. So with that, Kevin, were you able to get back on the line? I know you had an issue there for a second.
I think so. So we're going to try it here for just a bit.
Okay, great. Yeah, I can hear you. So I'll let you cover kind of the next session.
So Eric covered a lot of good information there, and I'm here to kind of address how we can assist. And so my name is Kevin Stewart. I'm a principal in the advisory function. I lead the client accounting service practice. Over the last couple of weeks, we've probably taken a couple of hundred questions and tried to address the specific questions that each of you have had and then may have going forward. I'd say over the next few weeks or the next 8 weeks, as you start accumulating information to seek forgiveness, we can definitely assist by answering those questions. And I'd say that's probably the biggest value we can add is acting as a sounding board and advisory board and kind of consulting on how to make sure that you get the most refund in your dollars. And so specifically as it relates to payroll cost analysis, the rules, although seem straightforward, in some ways are pretty complex just because there's some uncertainty of what they specifically mean. We've spent a lot of time the last few days determining what our interpretation of a full-time equivalent means, because there is a lack of guidance within the CARES Act. And so we're having to dig deep into the recesses of SBA documents over the last several years. We think we have a pretty good idea what that is now, but helping calculate an FTE, we can assist in providing guidance in that perspective. And then ongoing expenses, again, accumulating that information for your bank, and we can give advice and we can give insight and we can do the best of our ability, and we're assisting some of our banking relationships as well and helping them understand. But really, at the end of the day, a lot of this decision making is based on the bank's understanding, the bank's interpretation. So, but we can assist in developing that, helping to understand, getting the right information together to ensure as much forgiveness as possible with your banking relationship. We'll go to the next slide, and really a big piece of our connections over the last few weeks and even going forward is we do have a very strong connection of bankers and regulators and attorneys. I'd say 2 or 3 weeks ago, I'm not sure who was an SBA expert, but we have now several, on staff at B&V, and specifically the 3 of us on the call and even more beyond that. But we've developed that expertise through a lot of research, through a lot of connections and visiting with our connections of, again, bankers, regulators, and attorneys and more. And so to the extent that we can make connections to assist, get you to the right person to address your specific questions, we will absolutely positively do that. And with that, I think we step into kind of the next set of slides, which is around the tax, and Jason, kind of take it over.
All right, thanks. Yeah, and I think Eric said it best, you know, talking about just the, I think the word he used was astronomical amount of activity this has created. I think it sort of got crystallized for me a little bit when I was talking to a bank contact I have, and they said their bank typically did 7,000 to 8,000 loans in a month, and they did 50,000 last week. So I think that sort of speaks to just the absolute sheer volume of this. It's pretty mind-boggling. Looking at, again, sort of some of the tax updates since we last talked with you folks. So the time extension, originally, I think this was a very narrow extension. It was just kind of April 15th and just some individual payments first quarter, and it was very narrow. It wasn't like the storm extensions that I think we've unfortunately become used to of usually they would extend to some date in the future, and basically any tax filing from today to that extended date was pushed to that extended date. Originally, this phase one time extension did not work like that, but I guess they got a lot of pushback from taxpayers and have basically updated this to where it works more now like the traditional extensions we're used to. So they've put out a couple of notices here. We list them on the slide. They also have a real good FAQ page that actually probably answers just about any questions you would have. I would say, generally speaking, just about any tax filing, you know, 1040s, the corporate returns that were due April 15th, all of that is now due July 15th. The first and second quarter ES payments that were due April and June are now due in July. And virtually every tax filing got pushed back. There's a couple of narrow exceptions, but virtually everything did. Also, the state of Texas has followed, as has most states. And so Texas franchise is also July 15th. So yeah, here on this next slide, we sort of listed probably the most common ones, but if you have a specific filing that you're curious about, I would suggest you go to one of those web pages, and the IRS information is pretty easy to follow. Next slide. All right, so the FFCRA, this was the phase two, and to sort of refresh your memory, this was designed to help workers who were working at places that maybe didn't have very good medical leave, sick leave policies, and so they were really, you know, potentially having a difficult time with if they don't work, they don't get paid. And so Washington was trying to incentivize companies to go ahead and provide leave. And so they put in some mechanisms for paid leave. And in turn, you could get tax credits, payroll tax credits on those dollar for dollar. This plan was effective at the beginning of this month, April 1st. There's a lot of good information on it. This DOL webpage has dozens of questions that are answered on a daily basis that are actually very well done. I don't recommend going to a lot of government websites, but this one is actually probably one of the better ones. It's very cut and dried and easy to follow. Next slide. We actually, I don't want to get into too much detail with the FFCRA. I'm a tax guy, and it's probably a lot more employment law, kind of HR based, because it does end up with a tax credit, but in terms of the policies and procedures, a lot more of it is around similar to FMLA. And so what I would recommend is we actually had our HR director and another colleague at our firm do a webinar specifically on the FFCRA, how it works, the nuances of it. sort of how it relates to just the regular family medical leave that we've had for a number of years. So I highly recommend, if you have questions related around this, that webinar is probably a more appropriate resource for you than to try and get HR questions from a tax guy. So now moving on to the CARES Act, as we said, the CARES Act really had two main sections. There's the SBA loan program, and then there was a number of tax provisions in it as well. And so Eric's been kind enough to talk us through the SBA loan program. So we're just going to touch on some updates we've gotten related to the tax portion of it. So the rebate checks, those were obviously a very popular thing. I think most of us are pretty familiar with it. They could be as much as $1,200 each within certain income limitations. I think probably what I would highlight from this slide is the IRS has, I think it was just, it opened it up late last week and has added to it even some in the last couple of days. You can go to this IRS website and you can track the payments if you qualify for that. You can also supposedly update bank information to get direct deposit, although I've heard many of the direct deposits have already been made. If you had already filed your tax return and had refunds direct deposited, you potentially have already received your refund. I know I've got several clients who already have. So some of that has already been moving pretty well, but again, that is the IRS website that can answer any questions you have around those. This is probably, from the tax side, probably I would say the most important provision and information we can update for folks. There was an awful lot of confusion around this provision in the CARES Act. The CARES Act said, as part of its provision, that folks could delay the employer portion of the Social Security tax for their payroll taxes for the rest of calendar 2020, and half of it would become due December of 21, and half of it would be due December of 22. So it's not a credit, it's not a grant like the PPP, but it's the next best thing. It's deferral, and so you potentially could keep your cash now and pay it much later. The way the statute was written, there were many people who interpreted it to say if you got a PPP loan, you could not participate in this deferral of payroll taxes. But the language was unclear, and we finally just last week got guidance from the IRS on this. Again, we have the link to the IRS guidance, and actually go to the next slide. It is probably the question everybody asks. So in that guidance that we had listed there, part of it has a Q&A, and question number 4 on that says, can an employer that applied and received a PPP loan still defer the deposit for the employer's share of the Social Security tax? So I think what we learned from that, appreciate the IRS giving us some clarity there, that you can immediately begin this deferral of payroll of the employer portion of the FICA, which is obviously, probably one of the more significant pieces of the payroll tax. So you can begin deferring that immediately, and you can defer it for the rest of 2020. But if you do get a PPP loan, and at some point there will be a determination made about the forgiveness of it, once the forgiveness determination has been made, you can no longer, after that date through the end of the year, defer any of this any longer. So whatever you deferred between, say, today and whatever time the lender issues a decision regarding forgiveness is properly deferred under the CARES Act, and you would owe 50% of that amount December 21 and 50% of that in December of 22. But once the forgiveness determination is made, then you can no longer defer. So you sort of get it, but not for the entire year. For folks who do not participate in the PPP program, either by choice or because they're excluded. For example, we have a lot of clients that are owned by PE funds, and the PE funds are sort of outside of this. So for folks like that, they can take full advantage of this and defer, again, just the employer portion of the FICA, but they can defer that amount throughout the rest of 2020. Next slide. So NOL, that was another big provision in the CARES Act. You're able to carry back NOLs for a number of years. It was a very generous taxpayer-friendly provision. For those of you who have had to carry back NOLs to get tax refunds in prior years, you know that it's anything but simple. The rules can be very confusing. There seems to be multiple forms that potentially you could do this with. And so there's always a lot of taxpayer confusion on just how do I carry this back? What form do I use? What are the due dates and stuff? And so in theory, it's pretty straightforward, but in practice, it is very confusing. So the IRS has just actually within the last week issued a revenue procedure, and then they've also issued a notice giving people a little more time. So you've got until the end of June to carry back a loss from 2018. And if we go to the next slide, I stole this from the American Bar Association tax section. I thought this was an excellent chart they had put together that basically shows different taxpayers, different periods, which form you can use, what the due dates are, and where they're getting that authority. So this is sort of an excellent summary of, you know, if you can find which NOL you're carrying back and what you are in terms of, you know, individual or corp, you can see which form to use and what your deadline is. So use this. This is a great resource. Next slide. Also, we've been getting a lot of questions on the PPP loan program for self-employeds, and the IRS has sent out some of this. I mean, I guess we could have talked about it in the first portion of our presentation, but a lot of this gets around Schedule Cs and 1040s, and so they left it here with the tax folks. But it's fairly straightforward. They have just released, and you can see there April 14th, so just this week, some guidance on how the PPP program is to work for self-employeds. They also made some mention in there about partners and partnerships. So I think, you know, again, echoing Eric's comment, you know, the initial $349 billion has already been spoken for, but every indication we have is that additional funds at some time will be coming. So, so if you're self-employed and still want to apply for the loan, we strongly encourage you to work with your lender because hopefully the additional resources are coming. But go to the next slide and sort of talk about this. They don't say it directly, but if you read that guidance, it seems to sort of say if I'm self-employed but I don't have any employees, then what can I do, you know, in terms of what's my loan amount? I don't have payroll. So they sort of will treat a self-employed individual as if they are the only employee. So again, there you know, if you earned say 250,000 from self-employment, you're going to be capped at 100,000, just like an employee would under a business, under some of the limitations that Eric touched on in those calculations. So you know, you would have $100,000 compensation divided by 12. So your monthly compensation and the 2.5 multiplier would get you to a PPP loan of $20,833. So, you know, there may be some other things, you know, if you do have employees, that amount could go up. But for a lot of self-employeds, they don't have employees. So it seems like you're sort of limited to just that amount. Also, there can be adjustments for idle loans. That was discussed in the advice that was granted, and I think Eric touched on that. One thing, just as a practical matter, as many of you know, self-employed individuals file a Schedule C as a component to their 1040. Whether or not you have filed your 2019 tax return, you have to provide them with the 2019 Schedule C. It says that in the guidance, and I don't know if they're going to, if that has to be final, if it has to match your tax return. For folks who can't file their tax return yet, presumably whatever that Schedule C you turn over for this would need to be what your final Schedule C is. So maybe other tax items, K-1s and things like that that are still waiting to come in. You can file your tax return later, but that Schedule C, the amounts on it seems to be from this guidance needs to be pretty much finalized because they are going to base the loan on your 2019 Schedule C. Next slide. And so again, how do these loans work? They're going to work exactly like what Eric just talked about at the beginning of the presentation. You can use the money for payroll, which includes compensation to yourself, mortgage interest, the rent payments, utility payments. So it's those same buckets of expenses that we talked about. There's really no difference in the way that this loan is going to work for self-employeds versus regular businesses. The one thing I would point out that they did make very clear is for these items, they have to be deductible on Schedule C. And so where I think that comes in is if you think of a self-employed person who may be working from home, not all of your mortgage or your utility payments, say for your house, are deductible on your Schedule C. You may have an office and home, but the entire payment is not. So in that sense, you could not use those funds to pay your utilities or mortgage on your house because they're not deductible as your business expense. So you can only use whatever you get from the PPP for items that are deductible on your Schedule C. And, again, we have the 75% minimum for payroll. So I think for most self-employeds with that dollar amount, probably they're going to be at 100% payroll. So shouldn't be an issue, but we just caution you to some of those limitations that the IRS brought out. As I mentioned, there was some discussion in there around PPP loans for partners. They make it explicitly clear that a partner cannot apply for a PPP loan, that the partnership should apply. Now, one thing that seems to be clear from this, and again, maybe more guidance will make it a little more crystal clear, but one question we got a lot was, are guaranteed payments, if I'm a partnership and I want to apply for a PPP loan, are guaranteed payments considered payroll? It's not abundantly clear from this most recent guidance from the IRS, but I think most practitioners that I have seen comment on this and those of us in our office believe that generally the way they've defined what payroll costs are considered for partnerships, that it would include guaranteed payments. And if you think of the spirit of the law and the way guaranteed payments work, that would seem to be consistent. So again, backing up, the partners cannot file for this on their own, but the partnership could file, and it could, its loan amount would be its W-2 employee payroll costs plus any guaranteed payments that it pays to partners. So that would sort of be its payroll base, and it would be the borrower, not the individual partners. And I think that's all we really had in terms of the updates. We want to make you guys aware. Here are some really good resources. Again, I've been pleasantly surprised with some of the web pages the government has put out. They're not really, notorious for putting out great web pages, but some of this stuff has actually been pretty good. And also, at the top of the page there is our SBA site from our homepage, and we continue to update that with links that we think are relevant for our clients. We also include all of these presentations, recorded versions of this, as well as the slide deck. So all of that information is available at that address, which you can get to from our homepage. So certainly recommend, if you want to dig around and get further information, those are great. Those are all great resources. I think, is that all we had for today?
Yep, I think that should probably do it. The only thing I'll add to is that there's been another program coming out called the Main Street program, and that is being run by the Federal Reserve directly. And so that is still in its I guess infancy stages, but you may have seen some articles come out about that. So that's in addition to the additional SBA funding that we're hoping that will come through. That program is also in the works as well. So we're continuing to stay on top of that, and we'll push out, probably do another webinar, quite honestly, on that. So more to come, but we are staying on top of that as well. And that could be another very valuable resource for businesses going forward.
Yeah, that one seems to be geared at a little more larger businesses, maybe some of the folks that were excluded from the PPP program. It doesn't seem to have a forgiveness portion, seems to be a little more like a traditional loan, but very favorable terms and hopefully ease of getting it. But yeah, they had a comment period that was just closed yesterday. So hopefully we'll get some good details on how this program is going to work in the coming days. And yes, we will certainly, it's our anticipation that we're going to do a webinar on that and provide folks with info. But with that, I know there's been some questions asked. We will try and respond to those as best we can, potentially emailing out responses as well. With that, thank you again for sharing some of your time with us. Let us know if you have any questions, and stay safe. Have a good weekend. Thanks.